You know, in the world of business, there's this tool. It's so powerful, it can literally build an empire from scratch or bring one crashing down into absolute ruin. It's called leverage. Think of it as a force that can amplify a company's success to incredible heights. But it can just as easily magnify its failures. It truly is a double-edged sword. So let's break down how it really works.
So, what are we really talking about when we say leverage in business? Well, picture a simple lever, right? It lets you move a huge boulder with just a little bit of effort. The principle in business is exactly the same. A company's fixed costs, we're talking about things like rent, machinery, interest payments, they act as the fulcrum. They take the force of every single dollar of sales and just crank it up, turning even small changes in revenue into these dramatic swings in profit.
And yeah, that magnification, it is a two-way street. It works going up, and it works going down. Really understanding this is the key to seeing a company's true risk profile, which actually brings us to a really fascinating puzzle.
Okay, so picture this. You're an analyst, and you've got two companies in front of you. You look at their reports, and on paper, their bottom line profit, it's identical. So you'd think they're pretty much equally good investments, right? Well, the reality is way more complex. The real answer is hidden in how they use leverage.
All right, to really get this, let's dive into a tale of two companies that show this perfectly: Impulse Robotics and Malve Aerospace. At first glance, you'd swear they were twins.
So you can see here, both are pulling in $1 million in revenue. And look at that bottom line. Net income is exactly the same, 200 grand each. They look equally profitable. But like I said, that's not the whole story. Let's peel back a layer, shall we?
And here it is. This is the secret sauce, the big difference. So Impulse Robotics, they've got these huge fixed operating costs, $500,000, but making each individual unit is super cheap. Malve Aerospace is totally flipped. Their fixed costs are way lower, but it costs them more to produce every single item. This difference in their cost structure, that's the fulcrum, and it completely changes the game.
So what does this all mean when things change? Well, let's say sales take a nosedive and get cut in half. Malve manages to break even, but Impulse Robotics, they suffer a devastating $200,000 loss. Okay, now what if things go great and sales double? Malve does really well, earning 600 grand, but Impulse, their profits explode to $1 million. Impulse's profits are just way more volatile, swinging wildly with every little change in sales. That is leverage in action, right there.
Okay, so we can see this effect, but how do we actually put a number on it? Well, analysts break it down into two distinct types: operating leverage and financial leverage. Let's take a look at each one.
So first up, we have what's called operating leverage. This is all about the fixed costs of just keeping the lights on. You know, the factory, the salary employees, the heavy equipment. A high degree of operating leverage, or DOL, means a company's operating profit is extremely sensitive to any change in its sales. Now, for Impulse Robotics, the DOL is 2.67. So what does that mean in plain English? It means for every 10% increase in sales, its operating income skyrockets by nearly 27%. Malve's is much lower, at 1.6. Its income grows, for sure, but nowhere near as explosively. It's pretty clear Impulse is carrying much higher operating risk.
But wait, there's more. The second layer of magnification is financial leverage. This comes from how a company pays for all its stuff. If it uses a lot of debt, it's got these big fixed interest payments every month. This takes those swings in operating income we just talked about and magnifies them again on the way to the final net income.
So you've got this incredible chain reaction happening. It starts with a small change in sales, which then gets blown up by the operating leverage into a much bigger change in operating income. Then that change gets magnified again by financial leverage. The final result is a massively amplified effect on the bottom line, the number the shareholders actually care about.
And when you put it all together for Impulse Robotics, you get what's called the degree of total leverage, and it's a whopping 4.0. Think about that for a second. That single number tells us that for every tiny 1% change in its sales, up or down, its net income swings by a full 4%. That's incredible potential, but it's also incredible risk.
And that risk is very, very real. I mean, with high leverage comes a high-stakes game of survival, and the most direct way to measure this risk is something called the break-even point.
The break-even point is exactly what it sounds like. It's the absolute bare minimum level of sales a company needs just to survive. It's the number of units it has to sell just to cover all its costs.
Anything below that number, and the company is just bleeding cash.
So for our high-leverage company, Impulse Robotics, that number is 75,000 units. It needs to sell that many just to get its net income to zero.
Now compare that to Malve Aerospace. Because its fixed costs are so much lower, its break-even point is only 50,000 units.
Yeah, just let that sink in for a second. Impulse Robotics has to sell a full 50% more than Malve just to not lose money. We're not even talking profit yet. For a company with that much leverage, there is so little room for error. They're walking a very, very thin tightrope. And look, this isn't just some textbook example. In the real world, miscalculating the risks of leverage can, and absolutely does, lead to total corporate ruin. Take Webvan.com. They raised over $1 billion to build this massive network of high-tech warehouses. I mean, huge fixed costs, right? Well, when the sales didn't hit their crazy targets, the whole thing just collapsed. Or look at Owens Corning, a manufacturer whose high leverage made it impossible to absorb the shock of massive legal claims, and it forced them into bankruptcy. These are serious cautionary tales about the dark side of leverage.
So what's the big lesson in all of this? Well, it's that leverage itself isn't inherently good or bad. It's just a magnifier. Understanding a company's operating and financial leverage is absolutely essential if you want to understand its potential for massive growth and its potential for spectacular failure. It tells you the real story behind the numbers. So the next time you look at a company's income statement, don't just ask, how much did they make? Ask, how did they make it? Because hidden within that answer is the powerful, invisible lever that determines whether you're looking at a rocket ship or a ticking time bomb.